Happy
Hey,
Tuesday.
everybody. Happy Tuesday to everybody. I see Walt is here, Bill is here, Santo, Yvonne, Bob, Mark, Tang. Thank you guys so much, as always,
Coming from all over.
joining us live for a Stock from Scratch webinar. Mr. Stoffel, good to see you.
Good to see you. And I would say that those who are subscribed to our newsletter definitely have a preference for what we cover right now. Would you agree with that?
There's definitely a strong theme going on, and understandable why. So we asked what stock you want us to research live in our newsletter last week. The number one choice was Taiwan Semiconductor with 39.5% of the vote, beating out Uber quite handily. Now, semiconductor companies, we have found on a general, is this an easy company to research? Is this hard? It's definitely on the harder side of things to do. There's a lot going on with these companies, not to mention you need significant technical chops just to understand what they're talking about.
Well, that's like half of it. Yeah.
Right. So we want to know in the chat, is this a stock that you own? TSM, Taiwan Semi? Let us know. This is a massive company. I think it was a $2 trillion market cap the last I looked. Mr. Stoffel, do you own it?
I do not own it, but it is an area much like our subscribers that I'm spending a lot of time researching myself, because I think it's important. It's important to be in the physical world now. We've been in the digital world where it's been important to be for the last 20 years. With AI, it's important to actually be in the physical world.
I'm with Susanna. I own it through a fund. Yeah, I own it indirectly, but there's no doubt this has been a fabulous wealth creator for a long time now. This is like a $2 trillion company. So while those are coming in, the whole point of this episode here is to teach you how we go about researching a stock from scratch. We're going to be using our homemade tool, Stock Simplifier. 7 key things that we like to look at about a business, starting with number 1, Mr. Stoffel, and that is, what phase of the business growth cycle is this company in? Now, we have a new tool that our streaming platform just launched with us, where we can actually launch a poll. So we've never tried this before, so we have no idea how it's going to work. And I can only put in 4 options there. But which phase of the business growth cycle do you think Taiwan Semi is in? So in the chat, type 1, 2, 3, or 4.
It's a little confusing because they don't line up, but we went
I put numbers in there.
2 through 5.
Okay.
We're pretty sure that this is not a startup, and we're also pretty sure that this is not a declining company.
Right. So while that's happening, I opened up a fresh copy of Stock Simplifier. The ticker symbol here is TSM. I opened up access to our prompt library. I'm going to go ahead and copy that prompt over. We're going to be using Gemini again to do some research on this business. And it should be asking me what company. And this is TSM, Taiwan Semi. And let's see what phase.
Thank you for everyone for taking this hybrid approach of chat plus us testing out the polls. I'm going to go ahead and stop.
I'm guessing the poll goes to the chat, finds the answers, and then associates with them. That's how I'm assuming it's working.
No, I think people are typing it in. I think that the poll comes up on the page, but
I don't know.
Either way,
let us know. This is our first
time.
What
I see is 75% of people said capital return.
All right. Let's see what AI says. So as of fiscal year 2025, which was just filed in February of 2026, Gemini says phase 5 with a high degree of confidence. Why is it like that? Operating income is hugely positive. Revenue is growing. And the company has a dividend. Well, dividend's a pretty good sign. That means the company is mature with stable operations. And that means the high growth multiples and forward price of sales should be avoided. So they're a dominant semiconductor foundry market, producing the world's most advanced chips. They generate massive free cash flow and a significant technology lead, focus on stable earnings and maintaining high utilization rates, and geopolitical risks are definitely going to be the key things to understand. So I'll go ahead and, if they're paying a dividend, that's a pretty easy tell that they are in the capital return phase. Okay, next thing is to figure out, is this a good business or not? Is this a business that is worth investigating? We know it's a $2 trillion company, so they got to be doing something. They got to be doing something right. So here we have this prompt that we built for AI to go in to learn about the business. And let's research TSM, Taiwan Semi. Okay.
Drago asked, does the dividend get paid quarterly, annually? Do you know? Are you sure? Do you know if that how often they pay that out?
Well, let's look it up. We'll open up a fresh copy of Fiscal. TSM.
I see it now.
TSM is the ticker, right? Taiwan.
Yeah, so if you go down to that fourth one and then click on the 10 listings.
Oh yeah.
And go down and there you go. We're teaching people how to navigate this too.
So the dividend
go down a little bit and it shows you quarterly. See, June 9th is the next one. April 9th.
Yeah, pays quarterly.
Yeah. So there you go.
It looks like it's a variable dividend too.
Which is not, well, part of it might be because I'm not sure what it's paid out in, because it looks like it says NT, which is not US dollars. So that might be part of it, the exchange rate. It could also be part of the fact that non-US companies often do have variable dividends.
Yeah. Right. Which is, I think that's the superior way of doing it personally.
I do too. I understand that investors love the regularity, but if I was a business owner, I would much rather do variable dividends.
100%. So what does the company do? It's the world's largest dedicated semiconductor foundry. So unlike companies that design their own chips, TSM only manufactures chips for other companies. They specialize in advanced process technologies, the tiny circuit on a chip, currently leading the world in 3 nanometer and 5 nanometer production. So they don't design the chips, they make them for other people. So
but it's worth noting that I've since learned that companies will their design of the chip is based on what Taiwan Semi and specifically Taiwan Semi is capable of. So when NVIDIA is figuring out how to do this, they're doing this with Taiwan Semi in mind.
Gotcha. Okay. Sounds like a competitive advantage.
That is a competitive advantage. Yes, very much so.
How does it make money? The company earns revenue by charging customers for each silicon wafer it produces and for related design and packaging services. So high performance computing is 58% of revenue. This includes AI servers and PCs. Smartphones are 30%. Internet of Things are 5%. You remember the Internet of Things?
Yeah, it was supposed to be so big.
It was supposed to be so big.
Wow.
Automotive is 5% and digital consumer and electronics. So I wonder if Fiscal breaks these out as different segments.
Which I do believe that they do. If you go down.
Geography.
There you go. The next one, high performance. You know, that's worth pulling up. Pull that up because I want to show folks something if we stack those.
Yeah. That's exactly what I was going to do. So if we go up here and we click stack, 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 you can get a sense of the scale. So rewind the clock to 2017. It looks like high performance was 8 billion and smartphones were the dominant one. Fast forward to today, high performance computing has grown 29% per year for the last decade. Smartphones, a more mature market, but still growing 10%. Well,
so I think that's important though, is to think about the tough thing about Taiwan Semi is that it is historically cyclical, right? Yeah. So eventually, and I have no idea if this is 2 years away, 5 years away, 20 years away, our demand for AI chips will normalize. And when it does, it'll look like that blue area because the smartphone market is closer to saturation than obviously the AI market is. So at some point in time, that green won't be growing as fast. And that's what makes it tough to know what's going on here.
How big is this super cycle we're in?
Exactly. Where are we in that S curve?
I'm guessing it's pretty big though.
I'm guessing so as well.
That's where it is. Either way, it is good to see that this is 60% of revenue and the fast and the most important segment. So who are the customers? They serve fabless chip designers who do not have their own factories and system companies that design chips for their own products. Apple, NVIDIA, AMD, Qualcomm, Meditech. The company has significant customer concentration, meaning a small number of giant firms account for the large portion of sales. A $2 trillion company with significant customer concentration. Doesn't mean
Which
it's
isn't surprising. I mean, it's not their fault.
Where does it operate? The majority of manufacturing is Taiwan. The company receives money from globally. So North America is 77% of revenue, Asia, China, Japan, and EMEA.
And I believe they are opening their first plant in Arizona, I believe in 2028.
Which makes sense. I know that that's a big push for the US for geopolitical reasons. How often do customers buy? Customers buying is driven by product cycles, such as the annual release of new smartphones or the multi-rollout of AI data centers. TSMC enters into long-term agreements with major customers to reserve factory capacity years in advance due to the high cost of building new plants. That's cool. That gives them a ton of revenue visibility then.
Yep.
Can it raise prices? Yes. The company has strong pricing power because it's the only manufacturer capable of making the world's most advanced chips. The only manufacturer
that must be nice.
Capable of making the world's most advanced chip. Evidence shows that TSMC plans to raise prices for its most advanced processors by 3 to 10% annually to offset the higher costs for raw materials, power, and international expansion. Does this company have pricing power? In spades.
Yep.
When you are the only manufacturer, that is quite amazing.
I mean, it's probably amongst the top 10 most important companies in the world.
Probably, no doubt. What happens in a recession? The business is cyclical, meaning that it fluctuates with the global economy. It has shown resilience during the 2023 industry-wide slowdown. Inventory correction, revenue only fell 4% in local currencies, while many competitors suffered much worse. Management expects megatrends to keep demand high, even if the broader economy slows down. All right. So with that out of the way, red, yellow, green, what do you think of this business? Red, this is a confusing business or a business that does not interest you at all. Yellow, this is a business that you get. And then green would be this is a business that you are interested in owning. So I'm going to run that poll again. If that works for you, great. If not, just go right to the chat and put a number in there. I'd love to know what you guys think of this business. Red, yellow, green, any good?
I think I'm starting to see a very consistent pattern here.
Yeah.
I mean,
very common pattern here. I mean, when I hear pricing power and essentially monopoly, worlds only, that to me is monopoly for an incredibly important business. Historically, I have not looked at semiconductor companies because of the extreme cyclicality, but that has been the AI super cycle, I think, has overridden that.
Oh, you know what? We wrote in red, yellow, red. People might be confused.
Whoops. Yeah.
Whoops.
Sorry about that.
I think that we've got a pretty convincing answer here, though, which is green. I mean, when you say out loud, this is probably one of the, I would say it's top 3 most important companies in the world.
Yeah. No doubt about that. All right. Got a whole bunch of this done. So let's go through and next, Moat. Does this company have a moat? I think I know the answer before we even run this this prompt.
But how would you clarify it? That's the big question. What is it? A network? Is it switching? What is it?
I would love to know from our viewers right now. What do you think is this company's primary moat source? Network effect, switching a cost, low cost producer, intangibles, or counter positioning? So put in the chat what you think this company's moat source is, and then we'll have to check to see if AI agrees with us here. So go ahead and run this, and we'll see what we get as answers.
Yeah, which one would you choose? I don't see anything coming in the comments. It's a little bit, it's a little bit different. We've got some people saying intangible, a whole bunch of people saying switching costs. I would actually say intangible just because it's like process power if you're using the 7 powers.
Yeah.
they know how to do something that nobody else knows how to do.
I was going to say
there is Samsung, but nobody knows how to make these on small chips.
I would have said low cost production.
Okay, because because you could throw $1 bazillion at it, and no one's going to be able to do this.
Yeah, they've Highmore, whatever his 7 powers thing. He does have processing power or processing know-how. I think that, which I bundle into low cost production, basically, you can do something that other people can't.
Yes,
internally, and that is an edge for you.
Yeah.
TSMC dominates the semiconductor industry through massive economies of scale and technological leadership that competitors cannot match. It holds an estimated 95% market share in the most advanced 3-nanometer chips, creating a golden yield advantage that makes it the default choice for global tech giants. Low-cost production, this is present and widening. A massive cost advantage driven by sheer scale and its reputation. By producing the vast majority of the world's advanced wafers, they move down the learning curve much faster than any peer, integrating new efficiencies into production at a rate competitors like Intel and Samsung have struggled to replicate. Its CapEx budget of $56 billion, a 40% increase from 2025, and it is an offensive investment that reinforces its lead. Wow.
Yeah. I mean, how would you even try and put a dent in that?
Gross margin of 62% and operating margin of 54%. For every dollar in sales, this company generates operating profits of 54 cents. I think that's even higher than Visa.
That's crazy.
Insane. And
they're selling physical things. This is not a technology company. They're selling physical things.
Look at the difference here. So gross margin 62%, operating margin 54. That means within 8% of their revenue is dedicated to all operating expenses.
Yep.
I mean, I'd imagine that their sales and marketing expenses are extremely low.
Why would you need to? There's only one place to go.
Right. If there's a very concentrated list of people, but that's extremely efficient operations. Massive scale helps. Switching costs. It's present, and this is stable. For companies like Apple and NVIDIA, switching away is nearly impossible due to the specialized process technology. Moving to a design to a different foundry require a costly multi-month redesign of the chip architectural itself. Their deep integration creates a chip-to-system landscape where the manufacturer is a mission-critical partner, not a vendor. So if you said switching costs, you are also correct. 95% market share, 77% of total revenue comes from 7-nanometer or more. Great. Intangibles, present and stable. Intangible consists of the vast patent portfolio and unique foundry model reputation, decades-long image of neutrality, which builds a level of trust like Intel cannot match. Super power rail technology and the A16 represent a significant technical barrier to entry. No network effects. No counter positioning. Okay. Given that we just said there, let's try this. Red, yellow, green. What do you guys think of this company? Oh, stop that poll. What do you guys think of this company's moat? Red, no moat, and/or the moat is weakening. Yellow, there is a moat there, and it looks like relatively stable. Green, this is a company with a moat, and/or the moat that it is expanding quite rapidly.
And here's the thing. Usually when you get a company like we see here with Taiwan Semi, I get very worried. Very worried. Why? Because when a company has 100% market share or 95% market share, all it takes is one competitor coming in and offering the same thing, and it could cause the stock to collapse because all of a sudden there's an alternative on the block, which makes me very nervous. This is different. And the reason this is different is that it takes tens of billions, if not hundreds of billions of dollars to match what it is. Like, it would be hard to leapfrog. Maybe you could, but it would be hard to leapfrog. So it's hard for me to see how this wouldn't just be a super wide moat.
Yeah, I agree with you there. I mean, everything from just the business description indicated this company had an extremely wide Moat. Okay, up next, let's go ahead and take a look at this company's growth proposition. Does it have red, bad growth, yellow, decent growth, or green growth opportunities ahead? Two ways a company can grow. Way number one is get new customers. Way number two is get the existing customers to spend more. And there are subcategories to that. So we're going to try and answer this question. Does this company have growth potential? Now, over in fiscal, if you go to the overview section, we have a growth section right here. I'll go ahead and zoom in. This is a company that's grown its revenue 18% annualized over the last 3 years, 16% over the last 10. Earnings per share are growing 19% over the last 3 years. Revenue is expected to grow 28% per year over the next 2 years. And earnings over the long term are expected to grow 24%. This is for a $2 trillion business. $2 trillion business is expected to put up those kind of growth numbers. All right. That's the numbers. Let's get into all right. Why should we believe that those numbers are achievable? What are the underlying growth drivers that will unlock that growth potential for the company?
Yeah, and we've already got people chiming in with their own thoughts that, they don't even need to see what Gemini is going to say here. They believe that the growth potential is huge. And I totally get it. It's going to be really interesting when we get to the risks to talk about the geopolitical risks.
For sure. All right. Primary growth driver, marketing and sales, moderate. They're a pure play where the sales is primary technical R&D. Traditional marketing is low. R&D for open innovation platform is a key sales tool. All right. New distribution channels, not so much. New market expansion. Massive international expansion is underway. New fabs in Arizona, Japan, and Germany to capture sovereign AI demand and geographic diversification. Every company, every country out there wants their own ability to manufacture these chips in-house or in country. So
honestly, I feel like the geopolitical risk is less about, say, China attacking Taiwan and more about once these are set up in their locales, if the governments of those locales just decide to take control, which I think would be a terrible decision because you lose all the expertise if you do that. But yeah, I'm just throwing that out there. I don't think it's going to happen, but if China were to decide to attack Taiwan and do that, it would slow down the global economy so much, it'd be shooting themselves in the foot.
Yep. Acquisitions, not so much. Pricing power, definitely. They've already said they're going to raise prices. New products and services, definitely. They're moving to a 2 nanometer architecture and superpower rail technology, COWOS, advanced packaging, which is expected to exceed 10% of total revenue in the new era. So new products and services, and then customer retention, 95% market share, near total retention of the Magnificent Seven. So new products, geographic expansion, pricing power, and retention are the tapped matrix for this company. So I already saw a whole bunch of people basically say green, and I don't know how you conclude otherwise, right? This is a company that's just doing so well. And amazingly has really strong growth potential here. All right, next, key metrics. So Stock Simplifier will change the key metrics that we look at to judge the business depending on which phase of the business growth cycle the company is in. So let me go ahead and pull up my prompt and let's put that into Gemini. And then it should say what company you're talking about. And then we see Taiwan Semi, phase 5, capital return.
Look at you preparing.
I know what's coming. So let's do that. Now, this is the one that AI struggles with the most. So we will double check all of these numbers as they come in. But we already saw, I know one of the things here is revenue growth on a 3-year basis. I already think we saw that was 19%, if memory serves. Yeah, revenue was just about 19% annualized. So let's see if that's a good at least first check to see if I can get that correct. Hey, nailed it. So revenue, we want revenue growth to be over 10% per year. Taiwan Semi is putting up 19% revenue growth. Next thing is we want free cash flow conversion. Net income's great, but how much of that net income do you convert into free cash flow? We want this number to be over 90%. It's currently 58%. Let's double check that, but go ahead.
I will say the big thing about that number is we heard them say building new plants ridiculously expensive. Number one, building new plants in Japan, Germany, Arizona. Number two, I think that's why they're having such a tough time converting it, because that's where all of their capital expenditures are going to. You can see that it can get as high as 70%. It's probably never going to reach that 90%. And I think that's just one of those things that you have to accept.
Well, a key thing about this company is this is a capital intensive business. Very extremely capital intensive. Now, on the one hand, that helps to build the moat because there's only so many companies that can do this. But make no mistake, this is a company that does not convert its earnings into cash flow.
Nope.
It just doesn't. So this was as low
they've
as
got to consistently update all of their hardware.
30% previously, as high as 72%. So that tells me is that when you're looking at this company's PE ratio, its PE ratio should be lower than it would be otherwise because of the low cash conversion. This is what you would call low quality earnings. Low quality.
And that's not a knock on Taiwan.
Not a knock on the company.
Any company in Taiwan's industry is going to have low quality earnings.
Right. Low quality earnings. So that's just a feature of the industry. So let's say, again, holding all things equal, if this business would normally trade at, if a business like this would normally trade at, let's just say 20 times earnings, you should probably insist to pay 15 times earnings, lower multiple, because earnings will always be higher than cash flow. It's just built into the nature of the business.
Yep.
So just keep that in mind. So this is low, yellow flag, agreed. Next is EBIT to interest expense. We want to see, this says current value is net interest is positive. So they're making more money than they're spending in interest expense. So the balance sheet is in tip-top shape. Return on invested capital, 28%.
Let's check that one.
Yeah, that's a hard one for it to figure out. So if we go to capital efficiency, 40%. 40% extreme capital efficiency. And then capital returns, this says, for 23 years. So let's go ahead. 10% for sure. Mid-tier free cash flow conversion. This looks good. This looked really good. And this looked really good. So the only quote unquote financial flag is the low free cash flow conversion, which is just built into the business model.
Yep. It's all part. They're not doing anything to pull the wool over your eyes.
Right. There you go. Okay, next, execution risk.
Here it is.
What are the stumbling blocks for this company that investors need to be aware of? Let's go ahead and ask Gemini what it says. Taiwan. Oh, it's going to do it? No, didn't think so. Let's go ahead and ask Gemini what are the key risks we need to be aware of as investors. Now, we want to stress that all risks boil down to execution risk. So far, this company has had a fabulous history of execution, but can a company keep doing that moving forward? So this gives it a risk score of 2.25. This is out of 3. Geographic concentration and outside forces risk. Totally agree.
I don't think geographic matters so much as customer concentration.
Sure. It's got a fortress balance sheet, 811 billion NT. I guess that's
Taiwan dollars.
Yeah, in net cash, and a global fab expansion strategy. Okay. Concentration. Significant customer concentration remains a structural reality. Specific percentages are shielded. Historic, the Magnificent Seven dominate the order book. Geographic concentration is high, with the vast majority of advanced manufacturing located in Taiwan. I mean, it's right in the name of the company. Concentration risk, huge deal.
Enormous.
Offsetting that, let me ask you this. You're a big concentration risk guy. Does what we learned about the business and the switching costs hinge that at all for you? Or does that help you at all?
It does. I feel better about it because I don't see how someone could come along and say, yeah, we can manufacture 2 nanometer chips for you. Like unless Amazon or Tesla is building this inside of their bunkers right now, like I just don't see it happening.
Got it. Next, disruption risk. Not a problem. They are the disruptor. They're the enabler of AI, and they're holding an estimated 72% market share, 95% share of the most advanced nodes. So they're the ones that are powering the AI disruption. They're not. That's not a risk right now. I would agree with that. Although from what we learned, was it last week or 2 weeks ago when we did Intel is desperately trying to catch up.
Oh yeah, absolutely. There's really only 3 players. It's Taiwan, Intel, and Samsung. That's it.
Right. Outside forces risk, big time. Geopolitical exposure is extreme due to the cross-strait tensions with China and its role as a silicon shield for Taiwan. High sensitivity to international trade barriers and U.S.-China exports, which directly impact supply chain stability and high-end chip shipments. Competition risk, yellow. Intel and are expanding aggressively. TSMC's operating margin and superior yields suggest it maintains significant competitive buffer. Competition is normalizing, and their market share increased throughout 2025. That's unbelievable.
Well, I mean, the thing is that the demand is growing so much that really it's not about grabbing market share. Let me let's pause on this. It is not about grabbing market share because demand is so great. It's so great that if you're running out to get chips, it's not about who should I go to. It's more about who has capacity. That's the thing. So if they're grabbing market share, it's actually probably because they're building out their capacity. That's where we are. It won't always be that way, but that's where we are right now.
All right. Well, taking all that into account, what do you guys think is the riskiness level here? Red, very risky, super high risk. Yellow, moderate risk. Green, low risk. I will say for myself, when I high level, definitely a risky geopolitical and customer concentration. There are things that are offsetting that, namely the importance of these chips basically to every company, every country in the world, and the localization. So I think as the localization happens, that will slowly de-risk the company. And I also personally believe that this company's track record of execution is extremely impressive.
Yeah,
extremely impressive. So that does help to lower the execution risk for me, but I don't know how you would not call this at the worst medium risk.
To me, it's yellow. Again, I could be totally wrong about this. We could look back and say, oh, how sweet and naive Brian was back then. But I think that the biggest thing that holds us back is fears of China invading Taiwan. Now, I've never been to China. I've never sat in on any meetings there. But again, if you take over, you bring the global economy to a standstill. And that hurts everybody, including China.
Yeah, I think it's yellow.
I think it's yellow too.
And again, this is the reasoned probability here.
Yes.
I think the risks that are bringing up a Mags having switches away are low. Some kind of war with Taiwan. I have no idea how to handicap that, but let's just say that's a low risk given low risk in any given year, high risk measured over a couple of years. We also don't know if what kind of impact that would have on their business or anything like that, or what impact that would have on the world, really. But make no mistake. The reason we look at risks is if you're going to make this investment, you want to go in eyes wide open about what risks you are taking on.
Yep.
That's the most important thing, is that you're aware of those risks as they come in.
And next, just to really quick summarize, there's 3 parts to the risk, right? 1 is geopolitical. 2 is just waning, like we're closer to the top of the S curve than we think. That's number 2.
Okay.
And number 3 is kind of what Bob talked about here with Percy, that Tesla, they're planning 2 nanometer architecture, doing it with Intel. That's the third.
They want to do it in-house.
Demand, competition.
Yep, fair enough. Okay. Next, so we know all that. What's the best way to value this company? Let's look at some valuation numbers. Well, the company is in phase 5. So it's in phase 5. It's in the capital return phase. So that means trailing numbers. So trailing PE and trailing price to free cash flow are the likely the way to go. We'll take a look at each of them. So PE does work on this company. And if we pull up the PE ratio, let me scoot out that. PE for this company got down to 10, 11 at the bottom in 2022. Currently 36. That's on a trailing basis. Okay. Now let's look at price to free cash flow. Now this number should be higher.
Should be higher. Yep.
Yep. And there's the much higher number here. So this is why that free cash flow conversion number is so high. So because net income is higher than free cash flow, therefore price to earnings ratio is going to be lower than free cash flow consistently. So 62 times price to free cash flow, 36 times price to earnings. Both of those look like they're highs to me over that time. But since we're here, let's also take a look at the forward numbers. So those are the trailing numbers looking backwards. Let's look at the forward numbers.
Yeah, this is a situation where it makes sense to look. When you're growing 20% plus, I mean, look at the difference there. Look at that.
Yeah. 22 times forward earnings, whereas the peak, the trough down here got down to 10. And if I was to eyeball the average, I would say the average is about 17. So this is the average over the last 10 years. Keep in mind that when did AI become like a thing? Like 2023-ish?
Mm-hmm.
So if we were to kind of scoot to like the last only account for that.
It doesn't change it that much.
Yeah, the average is pretty close. The average for this business on a price to forward earnings is about 19, currently 2022. And then if we look at the same thing for price to free cash flow, I have a feeling we're going to see a similar number here.
They must have upped their guidance for forward free cash flow when there's that big drop.
That would be the big drop.
Yeah.
Average is 36, currently 37. And this company does pay a dividend, right? So let's actually look at yield. So for this one, higher is better, lower is worse.
Look at that. It got up to over 4% in 2020.
Wow, what a buy this company was in 2020 and 2023. 3% dividend yield, currently 0.75%. All right, given all that, what do you guys think of the valuation here? Red looks overvalued, say 20% above fair value. Yellow looks about roughly fairly valued. Call that within 20% either way of its fair value number. Green, very attractive, even cheap. So a green would indicate you think it's 20% below its intrinsic value here.
And while those are coming in and we see people giving their ratings, I will say, Brian, mine is yellow. The hardest part for me is not about competition. The hardest part for me is not the geopolitical stuff. The hardest part for me is knowing where we are in the S curve. Mm-hmm. That's the hardest part for me.
Yep. Do you trust the earnings?
If you build out the capacity and the demand dries up just as you're building that out. Now, I don't think that's going to happen, but I'm just saying that's very expensive because you can't just mothball a foundry like that. You've got to keep it operating.
There you go. I would agree with everyone that we've heard here. All right, taking it all in together. Actually, before we do that, let's run that sentiment analysis.
Yeah,
we have a nice sentiment analysis here. So, why is the stock done what the stock has done over the last year? What do investors think of it? What do the media think of it? What do analysts think of it? What is the sentiment analysis on this company right now? TSM, Taiwan Semiconductor.
I have to imagine people are pretty bullish on it.
I would think so as well.
We put it in thinking. That's our mistake there. We don't have it in fast.
Yeah, give me the answer quickly.
We'll go from Mark, who says the 2-nanometer chip production depends on a mix of semiconductor equipment from people like ASML, Applied Materials, Lam Research, Tokyo, KLA, So it's worth remembering that all those suppliers that put the pieces in those foundries are important as well.
There we go. Now I got it in fast mode.
There we go.
All right. What do analysts, what do everyone think? Okay. So over the last year, it's up 138%. That's pretty good.
That's pretty good.
As driven by demand for its advanced chip, such as the 3 nanometer years and the 2 nanometer in development. Its next earnings call is April 16th. Oh, look at that. 2 days. The outlook, bullish, record revenue, and a 28% dividend hike signal management's high confidence in the durability of it. So analysts are bullish, investors are bullish. The media is mixed. Tone summary. The sentiment has shifted from geopolitical anxiety to AI-fueled euphoria. The recent concerns about the Middle East conflict have added a layer of short-term caution. Massive revenue jump. So revenue jumped 45%. Dividend confidence, the huge dividend increase. Bulls are saying they are a monopolistic position. Very strong margins and a massive investment will maintain their lead. The bears are saying you're not considering the geopolitical pressure enough. There's cost pressure from developing in higher cost parts of the world, like Japan, Germany, and Arizona. And helium availability and potential Middle East war impacts are creating zero availability fears for some of the company's materials.
Yeah.
So fair. That would be the assessment of that. Now, I do want to show in the new stock simplifier that is currently in beta mode. We do have an assessment here of the company's management team, which we do not have a prompt for, but let's take a look at this. CC Wei has transformed from to a $1.5 trillion company or $2 trillion company. Seamless succession from the company's founder. Margin expansion is underway, and there's self-funding growth. Then we have these cool little tabs here that look at a couple of different things in particular. So do employees like working here? Ooh, 3.3 stars out of 5, and only half of employees recommend the company to.
I would wonder. I would wonder how popular Glassdoor is in Taiwan.
Probably not that. Probably not that popular. That's probably fair, but they're saying work-life balance is very, very poor. Do they exceed expectations? 8 out of 8 times. They have perfect 8 out of 8 record. Earnings per share more than doubled, and revenue guidance is always met. So this is a management team that executes. I love that. Is management shareholder friendly? Yes, they're shareholder friendly. Net zero dilution. The dividend is growing, and their balance sheet is still very strong. And then how strong are free cash flow margins? That's where it's mixed. Free cash flow margin bounces around due to the capital intensity of the business. But the new stock simplifier says, hey, this is one heck of a good management team. Hard not to agree, given that execution track record. All right, taking everything into account, are you interested in Taiwan Semi? Red, you think this is a business that is pass. Forget this company. Yellow, you like the business, but you might not want it to buy it right now. Perhaps this is a company that's a strong candidate for your watch list if indeed it does get cheaper in the future. And green, you like this company. You think it's a great addition to your portfolio right now at current prices.
Well, we've got basically mostly green with some yellow. I'll say for myself, this actually hadn't been, I've been aware of this, and I'm not even sure why it hadn't been on my watch list, but I just did my Valuation 360. And when I did, I didn't include this. I need to start including this. And I'm going to get some earnings in 2 days, and I can use that information to help make it a better outlook for the valuation.
Yeah, for me personally, I'm going to go with kind of. This to me is a great watch list candidate. It's a $2 trillion company. You don't get there without having an excellent business, strong business model, and all those things. It's a dividend payer. It's got realistic growth potential there. The risk is definitely there. So given the risk and the size of this business, personally, I would not make an investment in this company individually without a margin of safety, or at least in it being exciting to me from a valuation perspective, I don't think the valuation today is all that compelling. I think it's quite high. If I could have got this company for 10 times earnings at a 4% dividend yield, count me in, right?
Mm-hmm.
But I think it's pretty pricey, and I don't think this is the kind of company you want to chase up to own. Personally, I think it's a fabulous business. But for me, I would put it on my watch list, given everything that we just learned about it. Cool.
Should we let folks know what we have planned for next week? Because that's going to be a very interesting change of pace here. Well, do you want to tell folks you won't be here? What's going on with you?
I'm on vacation next week. So Mr. Stoffel will be here. And what you talking about next week?
So next week, I will be on here with a guest. Our guest is an individual by the name of Justin Lamb. Now, Mr. Feroldi just showed you our new stock simplifier, which is in beta mode. It was built primarily by Justin Lamb. He's going to join us, and he is using all the new AI tools to build it. So we're going to have him on, and it's going to be a free-flowing conversation where, one, I'm going to ask him to explain why this new release that hasn't really released from Anthropic called Mythos was such a big deal. But beyond that, this being someone who works with these new AI tools and is elbow deep in them every single day, I want him to give an insider's view on what might this mean for SaaS companies and which one should we be worried about, which one shouldn't we? Because it's interesting to hear us talk about it, but we're going to be talking with someone who uses these tools every day.
Very cool. By the way, I see some people here that already are beta users of the new stock simplifier. Did want to let you know we do have this cool feature in there that we just added. If as you're researching a company, there's a button right here. You can actually take it and write notes on it. So I like the CEO or whatever. So you can actually take notes, and it will actually capture those notes as you go. Side note, if you click this button right here, this is a highly integrated with Fiscal. So if you click that, it'll actually take you right to the company page in Fiscal if you want to do kind of a deeper dive. So we've really done, I think, a smart job with making these everything that you could want to do to research a company right there at your fingertips. And we can't wait to launch the new stock simplifier. So we're 3 weeks away. May 6th, Wednesday, May 6th is when we do launch the new stock simplifiers just to our wait list. If you do want to join the wait list,
over in the corner, right there, the QR code.
There's a QR code, but it's longtermmindset.co/waitlist. That's how you get on the wait list. So 3 weeks or so before we open it up for general purpose. We've been building it for a couple months. We have beta testers in there, and we are ironing out all the bugs and making everything nice and smooth before we do that.
All right.
Great. So we have a couple of users in here who are saying nice things about it. So yeah, great. If you guys like it now, just wait until it's really ready for prime time. So check it out. We think that you guys are really going to like it, and hope that you join the wait list. Well, with that, thank you guys so much for joining us today. Mr. Stoffel will be here next week to talk about AI, and I will be back in, I won't be back in 2 weeks. Take a couple of weeks off from streaming because we're in Omaha for Berkshire Hathaway's meeting in 2 weeks. So
you're not going to see people for 3 whole weeks.
I know, but it will be 3 whole weeks. Thank you guys so much for joining us and for spending some time with us. We look forward to doing this again in the near future. Bye.
Bye, everyone.